Institutions are targeting $300, but the market is doing the exact opposite. Welcome to Project NFLX. $338. That's the high-end institutional price target projected right now by analysts at 24/7 Wall Street. It's a number that absolutely demands your attention. It sets up the fundamental upside here, and it's based on a multi-year trajectory of extreme structural growth and sheer market dominance. But we have to look at the structural dissonance staring us in the face. On one hand, you've got these massive, long-term institutional targets. On the other, a plunging, frankly brutal current market reality. Right now, the price sits at exactly $87.02. That is a profound gap between the boardroom vision and the trading floor reality. So let's isolate the data and figure out exactly why. First up, the thesis: structural growth. Despite the recent collapse in price, the structural evolution of this company remains completely intact. Here is exactly what's driving the long-term optimism from heavyweights like Citi and JP Morgan. For starters, the ad-supported tier is now a massive, high-margin revenue engine, reaching well over 250 million active viewers. Then, we're seeing major live content integration, heavily anchored by the NFL. Add to that Incubator, their AI-driven animation studio built to drastically optimize costs. The fundamental engine isn't broken at all. In fact, it's aggressively shedding the old limitations of the traditional subscriber model. And the cold, clinical data absolutely proves this fundamental fortress. Just look at these first quarter 2026 metrics. Net income literally exploded to $5.28 billion. Free cash flow surged to $5.09 billion. That is exceptional liquidity generation, and they're deploying it for rapid debt reduction, crushing their net debt down to just $2.10 billion. Mathematically speaking, the financial foundation here is pristine. Now for the antithesis, the technicals. Because while the balance sheet is a fortress, the short-term technical structure is, well, it's brutal. The current price is broken. It's sitting at exactly $87.02, which represents a 26% decline over the past year. Now, to a fundamental analyst, that looks like a strategic discount. But to algorithmic trading systems, this is an active, ongoing liquidation event. The momentum indicators are confirming just how severe this downtrend really is. The MACD, the moving average convergence divergence, is tracking aggressively lower at negative 2.42. The downward momentum is fully active here. There is zero mathematical evidence that it's decelerating. And if you look at the relative strength index, it's currently sitting at 36.73. It is rapidly bleeding out toward oversold territory, which technically starts below 30. So while this does tell us that selling pressure is extreme, and sure, a technical bounce could theoretically happen, the overriding trend remains highly toxic for any immediate entry. The internal market mechanics are essentially telling a story of suffocation. The volume-weighted moving average at $89.13 was initially tested as a psychological support level, but it failed. It has now inverted into a very heavy ceiling of resistance. The volume profile confirms this decline. Every single rally attempt is actively sold off the second it hits this exact mark. Which brings us to the wall. The absolute ceiling. This is the ultimate technical barrier dictating the broken market structure right now. The ceiling is absolute. The 200-day simple moving average is looming way up there at $102.56. This metric strictly defines the long-term bearish trend. So the asset remains in a state of decay until this exact level is definitively reclaimed with sustained, heavy volume. Next, let's look at risk, the capitulation assessment. Consider this a stark, emotionless warning regarding the immediate downside risk. The immediate floor right now is the lower Bollinger Band, situated at exactly $84.62. This is the final line of dynamic support. If we see a confirmed breach here, it signals total technical capitulation. A vacuum will open right beneath the price, targeting a rapid, vicious descent toward the $77 range. Therefore, the rule here has to be strict and purely numerical. $84.60 is your hard stop loss. Do not try to catch the falling knife. If this specific level is triggered, the systemic risk entirely outweighs any potential reward. Capital preservation becomes mandatory. Period. Finally, the synthesis. Tactical resolution. We have to bridge the gap between this pristine fundamental data and the brutal technical reality. The final verdict? Hold. Look, for long-term portfolios, the structural pivot definitely justifies patience, but you cannot blindly deploy new capital into a downtrend like this. So here is the protocol. Monitor the volume-weighted moving average at $89.13. We need to see a confirmed daily close above that level before even considering an entry. If that triggers, the primary institutional target is $115. Respect the macro headwinds and absolutely respect that hard stop loss at $84.60.
Vanguard Neural, intelligence for the decisive. The data is all laid out right in front of you. The only question is, will you act on the fundamental reality of tomorrow, or will you let yourself be liquidated by the technical reality of today?